So far, this entire series has been built around one foundational, almost universally accepted idea. The safest way to play a gold rush is to sell the shovels.
Exactly right. We have spent the last 4 episodes walking systematically through the infrastructure layer of this artificial intelligence supercycle. We looked at the heavy transformers and switchgear with Eaton. We analyzed the massive gas turbines with GE Vernova. We mapped out the thermal management and liquid cooling systems with Vertiv. The market absolutely loves these companies. They are the trusted names, the physical, tangible backbone of the AI build-out. And because the market has immense trust in their backlog, they are trading right near their all-time highs.
But today, we are crossing the Rubicon. We are moving away from the companies that build the shovels and turning our attention to the companies that actually swing them. We are leaving the relative safety of the equipment layer and entering the highly volatile generation layer. We are talking about the companies that actually produce and sell the electricity that powers these data centers.
Welcome back to The Working Thesis. I'm Theo.
And I'm Maya. This is episode 5 of the AI Power Chain. Today, we are focusing on NRG energy. And what you're going to notice immediately is just how differently the broader market treats a power generator compared to an equipment maker.
It is a completely different animal. You aren't buying the supplier anymore. You are officially renting the miner. And the market's pricing of that inherent risk tells a fascinating story. Let's get into it.
Quick, honest note before we dig in. This is just 2 curious people thinking out loud for learning and for fun. It's not investment advice and never a buy or sell call. So always do your own homework. Let's start with the immediate trigger. How did NRG energy end up on our screen for this specific series? When we run our structural scans across the power and utility sector, looking for the underlying beneficiaries of grid expansion, NRG immediately jumps out because it has one of the largest valuation gaps in the entire group.
It screens remarkably cheap compared to the broader AI infrastructure play. But here is the immediate twist, and it is a detail you absolutely have to pay attention to. Unlike the equipment names we just mentioned, like Eaton or Vernova, NRG is not trading anywhere near its highs. In fact, it trades deep below its recent highs, and crucially, it is sitting completely under its 200-day moving average.
That is the technical anomaly that flagged it for us. The artificial intelligence demand narrative is everywhere you look in the financial press, but the market is heavily discounting this particular slice of the power chain. The market's deep skepticism is the actual story here.
Exactly. We have a separate explainer video that breaks down the exact methodology of how we run these structural scans, detailing our RSI parameters and moving average filters. So we will keep that purely structural methodology light here. But the primary takeaway is that NRG is on the radar precisely because the market is forcing us to ask a difficult question. Why is the generation layer being structurally punished while the equipment layer is being continuously rewarded?
To answer that question, we have to establish the core teaching point of this episode. Generation is not equipment. These 2 layers absolutely belong to the same overarching AI power theme, but their business models are fundamentally opposed in how they absorb and process risk.
Think about a company like GE Vernova or Eaton. An equipment maker is fundamentally a backlog business. They manufacture a heavy-duty turbine or a substation transformer. They sell it to a grid developer, and they get paid their margin. It simply doesn't matter if wholesale power prices in Texas spike to $5,000 a megawatt hour in August or crash to $20 in April. It doesn't matter if the developer actually makes a sustainable profit running that plant over 20 years. The equipment maker got paid for the hardware up front. They win no matter who ends up dominating the power grid.
A merchant power generator, on the other hand, lives and dies on those daily power prices. They are the entities taking on the intense operational and market risk. They buy the turbine, they continuously burn the fuel, and they sell the resulting electrons into a real-time, highly volatile, open market.
That represents a drastically higher potential reward when market conditions align perfectly, but it comes with intense structural risk. When you look at a merchant generator, you aren't just betting that more data centers will be built globally. You are betting on the localized spot price of electricity at specific nodes on the grid, at specific times of day, under highly specific weather conditions.
It is exactly why NRG trades significantly off its highs, while the equipment makers sit comfortably near theirs. The market is perfectly comfortable underwriting the predictable backlog of a hardware manufacturer. It is significantly less comfortable underwriting the volatile, weather-dependent, regulatory-heavy earnings of a merchant power plant. It's the same overarching macro theme, but a very different animal.
So let's look at the business itself to understand what we are dealing with. What is NRG Energy? At its structural core, NRG is a massive merchant independent power producer, an IPP.
That distinction matters. They do not operate entirely as a traditional regulated utility that gets a guaranteed fixed rate of return safely negotiated with the State Utilities Commission. As an IPP, they operate in competitive wholesale markets. And for NRG, their absolute center of gravity, their primary battleground, is Texas, operating within the ERCOT grid.
But they aren't just a pure-play generator. Under the leadership of Chairman and CEO Larry Coben, NRG operates a highly integrated model. They have the generation fleet, the physical power plants, but they also have a massive retail electricity book. They sell power directly to millions of residential homes and commercial businesses under consumer brands like Reliant.
This integrated model is designed strategically to act as a natural hedge. When wholesale power prices spike due to grid scarcity, the generation side of the house mints money, even if the retail side gets squeezed on their margins. When wholesale prices inevitably collapse, the retail side expands its margins as their input costs drop.
And they just made a massive transformative bet to scale that generation side. NRG recently announced it is roughly doubling its generation fleet by acquiring about 13 gigawatts of power plants from LS Power for around $12 billion.
That is a staggering acquisition in terms of sheer scale. It is largely a natural gas fleet, which gives them the highly dispatchable, turn it on when you need it power that is absolutely critical for balancing a Texas grid that has become heavily dependent on intermittent wind and solar. 13 gigawatts is enough baseline power to serve millions of homes, and overnight, it dramatically increases their structural leverage to Texas power demand.
And that brings us directly to the AI kicker. Why does a company want to spend $12 billion to double its natural gas generation fleet in Texas right now? Because the ERCOT electricity load is exploding.
ERCOT's projected peak load is rapidly pushing past the 100 gigawatts threshold, and a massive, undeniable driver of that forward demand curve is data centers. The hyperscalers are moving faster than the traditional grid infrastructure can handle. They simply cannot wait 5 to 7 years for a new high-voltage transmission line to be permitted and built.
Which leads perfectly to the bring-your-own-power model. NRG is actively signing data center power deals where the data center developer co-locates their facility directly adjacent to the power plant. NRG is targeting at least a gigawatt of long-term contracts specifically for this type of bring-your-own-power setup.
This is where the macro narrative meets the corporate balance sheet. By contracting directly with a hyperscaler behind the meter, NRG locks in a long-term, highly stable cash flow that essentially bypasses the extreme volatility of the broader ERCOT wholesale market.
But tellingly, management has drawn a very hard, highly disciplined line. They have explicitly stated on earnings calls that they have zero interest in building speculative new capacity.
That is a crucial discipline signal for investors. They are telling Wall Street clearly, we want contracted, guaranteed demand. We are not going to spend billions of dollars building a brand new gas plant just on the speculative hope that a data center eventually shows up to buy the power. They want the off-taker fully locked in before they put a single shovel in the ground. It is a very clear signal that they want to capitalize on AI demand, but they absolutely refuse to gamble the balance sheet on it.
But despite that stated capital discipline, we have to talk about the catch. The honest, inescapable core of this entire business model is merchant risk, and that market exposure cuts fiercely in both directions.
Let's look at the upside scenario first. When power is scarce and spot prices spike, think about those brutally hot Texas summers in August, combined with surging structural demand from industrial data centers and a late afternoon where the wind generation just abruptly stops blowing. A merchant generator mints absolute money.
The spot price of wholesale power in ERCOT can jump from $40 a megawatt hour to several $1,000s in a matter of minutes. If your natural gas plant is running smoothly and selling its output into that acute scarcity, the cash generation is astronomical.
But then there is the downside reality. What happens when overall grid supply catches up to demand? What happens if there is a massive, subsidized overbuild of solar fields and utility-scale battery storage across Texas, and the baseline price of power falls through the floor?
Earnings can swing hard the other way, very quickly. You still have the immense fixed costs of operating, staffing, and maintaining those massive natural gas plants, but the market is no longer paying you a premium for your electrons. That structural volatility is the defining feature of the business. It is the perfect embodiment of the higher reward and higher risk reality of renting the miner instead of just selling the shovel.
Which brings us perfectly to why the broader market is treating NRG with such intense, visible skepticism right now. When you look at the chart, the overarching story is written clearly in the price action.
NRG trades well below its recent historical high, and structurally, it is sitting distinctly under its 200-day moving average. The market simply isn't convinced yet that the good times are going to last. It is actively pricing in doubt.
Wall Street analysts are looking at the ERCOT market, looking at the billions of dollars flowing rapidly into grid-scale batteries and new solar capacity, and they are deeply worried about an impending overbuild. They are worried that the scarcity pricing that has generously boosted merchant generators recently is going to evaporate, leading to a severe downward re-rating of the stock.
Put that chart reality next to the equipment names we discussed in earlier episodes. GE Vernova and Eaton are trading right near their all-time highs, riding a wave of unshakable confidence. NRG is in a defined, recognizable downtrend. You are literally looking at a real-time picture of what the market currently believes.
The market firmly believes in the certainty of the hardware backlog. It does not yet believe in the durability of merchant power prices, even with the AI data center narrative acting as a massive, generational tailwind. The skepticism is heavily priced in.
To understand NRG fully, we also need to place it accurately among its industry peers. Who are the other big players operating in this merchant generation space?
The peer group is actually quite tight, but they are all built very differently under the hood. You have Vistra, ticker VST. You have Constellation Energy, ticker CEG, and you have Talon Energy, ticker TLN.
NRG's particular operational mix is heavily weighted toward natural gas generation, combined with that massive retail customer book we mentioned, and it is overwhelmingly concentrated geographically in Texas.
Compare that specific profile to Constellation, which is heavily reliant on operating the largest nuclear fleet in the country. Or look at Vistra, which carries a distinctly different geographic footprint and fuel mix across multiple markets. Or Talon, which made massive headlines earlier in the cycle by selling a data center campus directly adjacent to its nuclear plant in Pennsylvania.
We are sticking strictly to the facts here. This is the merchant IPP peer set, not a ranking or a competition of who is best. But it is important to understand that when you analyze a merchant IPP, you are looking at a highly specific blend of geographic exposure, nuclear versus gas fuel types, and varying degrees of retail integration.
Now we need to objectively look at the structural risks, and there is an incredibly important nuance here regarding how you actually read their financials. First, the standard risks, merchant price swings, as we've just discussed in detail. You also have the immense execution risk of integrating a huge $12 billion acquisition with the LS power assets. And you have significant regulatory and political exposure operating heavily in Texas.
ERCOT is a highly political entity as much as it is an electrical grid. Rule changes coming out of the legislature in Austin can fundamentally alter the underlying economics of a power plant overnight. But the most crucial risk for anyone trying to model this company financially is this. NRG's earnings stream is incredibly noisy.
To give you a very specific factual example, if you look at their first quarter GAAP net income, it swung down by roughly $625 million year over year. If you just read that headline number on a stock screener, it looks like an absolute disaster.
But you have to understand the underlying accounting mechanics. Merchant generators use complex financial derivatives to hedge their future power sales. Under GAAP accounting rules, they have to mark those forward hedges to market every single quarter. If forward power prices move sharply in a certain direction, the accounting value of those hedges swings wildly, creating massive, non-cash impacts on their reported net income.
So while some traditional valuation measures might make the stock look remarkably cheap right now, a noisy earnings model means you should treat any cheap read with extra skepticism.
It is the perfect textbook example of why a valuation number, like a trailing PE ratio, is merely a guide, not gospel. When the underlying earnings are subject to massive non-cash mark-to-market swings, surface-level valuation metrics can be incredibly misleading. You have to dig much deeper to see the real cash generation.
Let's look at the technical map. And we always frame this carefully. These are strictly reference points, not predictions. As of early July, NRG trades deep off its recent high and well below its 200-day moving average.
So on that primary structural measure, the stock is still clearly in a downtrend. On the downside, the immediate level to watch is its 50-day moving average, and if that breaks, a deeper support level established during the spring lows.
On the upside, the level that matters most is reclaiming that 200-day moving average. Until the stock can cross back above that line and demonstrate it can hold it, there is no confirmed structural uptrend, and far above that sits the prior high.
On valuation, as we just discussed, it screens cheap, with an analyst median target sitting well above the current price. But given those extremely noisy earnings and the massive mark-to-market swings, you have to treat that median valuation target with extra skepticism.
These are levels that move every day. What you do with this structural map is entirely your call. We are not taking positions. This isn't a call to buy, and this isn't a warning to not chase. We're simply laying out the geography of where the broader market is currently assigning value and risk.
Which brings us to the summary. If you had to distill NRG energy and this entire generation layer down to a single sentence, what is the working thesis?
NRG is the high-torque way to place surging power demand, if, and only if, the market decides to trust it again.
It has the massive scale, it has the direct Texas exposure, and it has the targeted data center tailwinds. But until the market gets fully comfortable with that underlying merchant risk, it remains a heavily scrutinized, structurally discounted asset.
That wraps up episode 5 of the AI Power Chain. As always, do your own research and manage your own risk. We are building a structural framework for how the AI power chain connects across different sectors, but this is never financial advice.
Next time, we are moving one step further up the structural chain. If the generation layer is the heart of the modern power grid, what is the underlying fuel?
In episode 6, we are going to look at Cameco and the massive structural demand for the nuclear fuel that quietly underpins the most reliable generation layer on the planet.
We'll see you then. And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one, and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself, and keep asking good questions.